Hey everybody, this is Jose Blasco. We are about to start. As always, I would like to have a quick sound check to double check and confirm that you hear my voice, so I can confirm that we are ready to get started. Please give me a quick message on the comments box so I know that you hear me, and therefore we'll be ready to start. Very good. Thanks for that, Bojan. Wonderful, perfect. Okay, so we just got to the top of the hour, which means it's time to get started. See, here I am maximizing our presentation slide so we can have a proper official introduction for the session, and therefore we can begin. So here we go. Welcome to the session, my friends. My name is Jose Blasco. I will be your guide today. Today is July 27, 2019. And today we are getting together for sharpening purposes. So today we're going to be sharpening our skills, getting to understand better and better how trading works, how the markets work, how to apply a trading methodology, how to use the AutoUFOs, how to combine all those different things that we do, no matter the trading style that you implement, no matter if you're an intraday trader, no matter if you're a long-term investor or anywhere in between. We'll be sharpening skills to take care of every single angle of trading and all the different possibilities available in the marketplace. Before we start though, we have a disclaimer. So as always, I'll do the disclaimer quickly, and therefore that way we'll be able to jump in the session. So disclaimer, the following videos, clips, demonstrations are for educational and instructional purposes only. Tradictive provides these videos purely for the purpose of demonstrating a method of using the product. Users understand that all the content used in the video is purely for demonstration purposes only and is not a guide and does not provide any indication or prediction of actual results. As a user, you understand and agree that hypothetical results obtained through a demonstration do not indicate in any way the results you may receive on using our products, and this takes care of the disclaimer. So here we go. Ready to begin the session today. Here is our beautiful TradeStation. Beautiful TradeStation. Here is the workspaces that we use for short-term trading, isn't it? We also have here the other workspace, which is the one that we use for longer term, which means swing trades, position trades, etc., etc. And apart from that, I have a collection of documents to share with you today, because the idea today, in today's sharpening session, what I would like to do is to utilize one of the documents that I recently completed, which is these flowcharts that I flashed very quickly on the last session on Thursday. And I would like to go ahead and go deeper into the flowchart, take advantage of the flowchart to do two things. Number one, to review and get quite deep into the details of everything we do, each step when applying the trading methodology. But also a second reason for the flowchart is to kind of explain how to read it, how to use it, so that way you can just put it next to your keyboard, and when you are in the process of putting a trade in place, you can always remind yourself of the right process to follow. And I think that could be a very, very powerful review to some of you, and a very powerful new lesson day, sharpening session if you wish, where we're gonna basically expose you to a complete trading methodology on how to identify entries and exits for long and shorts while you manage your risk, while you manage your trade, once you get into one of them. Okay. Wonderful. That's the plan for today. And yeah, I'm just reading your comments on the comments box. All good. Very, very glad to see your names. Always happy to get together. And I also understand that getting together over the weekend implies that in one hand you may have more time to get together because it's the weekend. In the other hand, doing this session after the week is over, then normally you have other responsibilities in your life, in your family, etc. So joining me in the session is greatly appreciated. Okay, so very happy to see you guys. Let's begin. Okay, so we're gonna be using a collection of documents in this session, which, by the way, I'll be more than happy to email you if you don't have them yet after the session is over. You can always email us using let me write it down. So reach at tradewithufos.com. You can always email using that email address, at any moment in time and request the documents I will be utilizing today in the session, and will be more than happy to email you so you have them. Okay, so one of the documents I'm going to be using, as I just said, is a flowchart that defines the process on how to look at one trade beginning to the end, from the planning to the execution, and after the execution is over as well. Okay, that's the first thing that we're going to look. The other documents that we'll be utilizing in this session is documents that we have used before, where there is a complete summary of the right time frames. Wait a minute, I just happened to close the document by mistake. Let me open it again. The right time frames to be used when planning those particular trades. Okay, so in this case I am flashing very quickly, I'll get deeper into this later. I'm flashing very quickly the document that points at time frames to be used for a collection of different futures markets for intraday trading. Okay, we'll look as well at the forex, we'll look at the longer time frames as well, because the methodology, the flow chart, not only applies to the short term but also applies to the longer term trades and anywhere in between. Okay, so we're going to be looking at those documents with all the time frames. We will also be using those documents based on the flow chart, and putting it all together as we go. And again, I believe today is going to be a very, very powerful lesson for the ones of you that have been attending the lessons for a while. Yes, I will enlarge it. No worries, Subhash. I'm going to get deeper into everything, so I will zoom in, zoom out. No worries. So again, as I was saying, this session is going to be very powerful for the ones of you that have been attending the sessions for a while, and you will know for sure a lot of the content that I will cover today, but we'll get deeper and we'll kind of put structure around it and clarify, and it's going to be powerful because of all of that. And for the ones of you that are part of the sessions for not so long, well, this is going to be a major eye-opener, because starting from now on, then any session that we conduct into next week and beyond, you will follow 100% everything that we're doing. Where at the moment, I know that some of you haven't had the time to watch all the videos that we have recorded and available in the archive in YouTube, and therefore maybe there are times where we are conducting sessions and you are a little lost maybe, or you have a couple of questions that you are not sure about, right? So today the goal is to clarify everything, so we are all in the very, very, very same page, where everything we do is mechanical, everything is defined, there is no wondering, there is no thinking about it, there is, we just follow a process. That's it, very simple. Okay, let me see your comments. Maca, Jose, would it be okay to post these documents to our channel in Discord and the Telegram this way? Yes, I'm happy to do that, but if you don't mind, Maca, a quick email as a reminder would be appreciated, so the team can take care of that. Okay, Subhash, yes, as I was saying, I'll be zooming in and out. Okay, so let's begin with the flow chart. Okay, and I'm gonna zoom in here a little bit. Okay, notice that when looking at the flow chart, of course, we have a starting point, which is going to be all the way on the top. And notice that this starting point begins with the word restart. Okay, so actually it's not a starting point. It's a starting point that works in a cycle. Every time we will have a close on the common time frame, we will restart the process. In other words, I need to explain two things. What is the common time frame in case you don't know, which I believe most of you should know, but just in case. But assuming for a minute that you know what is the common time frame, so every time you have a new close on the common time frame, let's say the common time frame is 15 minutes. So every 15 minutes, every time you have a new close, if you have not got filled into any trade, you will need to restart the process. Restarting the process may imply canceling the trade you were about to execute because you didn't get filled in that 15-minute period, or restarting may imply confirming the trade that you already put in place, okay, that the trade is still valid, and therefore you just keep working on the same trade you already planned. But because you don't know if the trade that you already planned will be valid into the next 15 minutes or not, then you will need to restart the process every time you have a close on the common time frame. So what is the common time frame? Okay, so quick answer to that, because of course if I start talking about time frames, so this could be a long conversation. Okay, so let me make a little bit of space just to make a few notes as a reminder. Okay, we have all of these recorded. So when it comes to time frames, the methodology we use utilizes two time frames. One time frame, we call it the common time frame, and the other time frame that we use, we call it the edge time frame. Okay, and quick thank you as well to Brian for this suggestion. I love the name edge time frame. It's such a beautiful name, right? Because it gives you an edge. So the common time frame and the edge time frame are the two time frames that we use to plan a trade. And then optionally, which means that not all of you will do, we use a reactive time frame, which is a third time frame that we use when the goal is to look for a little bit of an additional extra amount of evidence that kind of proves to you that the trade you are planning to do actually makes sense, okay? And you will get a little bit more evidence of that. The danger of looking for too much evidence is that you may miss the trade. So the outcome of using reactive timeframes is that you will be more accurate most of the times, but sometimes you will miss the trade, okay? Which is okay, but that's the outcome and you need to know. And that's why it's optional, because some of you may have very limited time to trade, or you may have a personality where you don't appreciate at all missing trades. You just want to execute anything available and miss the rules. You just want to take it, okay? So then you will not use the reactive time frames, and you will simply focus on the common time frame and the edge time frame, okay? Now, those two time frames are a must. You can't plan a trade only using the common time frame or the edge. I mean, you could do anything, but then your odds would be less. And if you were to only use the edge time frame, which is going to be the key, okay, well, it would be also a mistake to take trades using the edge time frame without first checking the common time frame. Why is that? Because the goal of the common time frame is to have you understand what is the market climate. So what do I mean when I use the market climate? You have heard me use the term climate, environment, market condition. Maybe we can even use the word sentiment. Maybe we can even use the word trend. I mean, we can use many names, okay? But in the end, basically what the common time frame will help us to do is to identify, number one, if it's time to trade or not. And number two, if it's time to trade, should you be long or should you be short? So knowing what is the likely direction in which the market will move, it's critical before you plan your entry. Because if you don't know that, then you may be taking longs when it's time to go short, you may be taking shorts when it's time to go long. So the common time frame is called common because what we are trying to do is to understand what is everyone out there doing. That's why we use common time frames. And why is that important? Because the only way to make money is to have more people do the same thing you did after you did it. Right? What does that mean? That if you're going to be buying, the only way you profit is that you got more people buy after you bought. If you're going to be shorting, and therefore you sell, you need more people sell after you sold. That's the only way you make money. So because you need more people doing the same thing you did after you did, you cannot look at some weird time frame that only you are looking at. You want to look at those generic time frames that everybody looks, okay? And that's why we use common time frames, okay? And what are the common time frames? The common time frames are the ones that come by default with all trading platforms. For example, the monthly time frame. For example, the weekly time frame. For example, the daily time frame. For example, the 4-hour time frame or 240 minutes. For example, the 1-hour time frame or 60 minutes. And finally, we get to the 15-minute time frame and we stop there. Okay? You can go to the 5. The 5-minute time frame is also common. Okay? But then the problem is that in most markets, that will become too small, and therefore your distance between entry and stop will be too narrow, and therefore your probability of being stopped out is too great. Okay, so this will be the, let's call it the normal process. Okay, monthly, weekly, daily, 4-hour, 1-hour, 15. Those time frames are available with 100% all trading platforms worldwide, no matter the platform, no matter the software, no matter if it's Windows or Apple, no matter who is your broker, no matter if it's a desktop application or a web-based browser or even an app on your phone. Okay, that's why we use those time frames, because everybody sees them, because we need to make sure we are on the right side in the market. We need to make sure we got more people buy after we bought. We need to make sure we got more people sell after we sold. This is reason number one. There is another reason which you may remember, which I will phrase later on. So Time frames. The common time frame is the one that we'll use to understand the market climate. So we know if it's time to go long, or if it's time to go short, or if it's time to do nothing. And then we use the edge time frame. Why do we use the edge time frame? We use the edge time frame, which is let's call it a weird time frame. Even though weird sounds negative, to be honest, in this case it's positive. A time frame that not everybody uses will give you an edge, because you will find entry points that not everybody sees. And that's important, because for you to buy, someone has to sell to you. For you to sell, someone has to buy from you. So you don't want too many people to realize it's time to buy, or too many people to realize it's time to sell. So you need to use those edge time frames that very few people use. And by the way, the people that you want to use, you don't want it to be people, you want it to be computers. Because you're going to be leading against big piles of unfilled orders identified by the AutoUFOs app, isn't it? And you want those unfilled orders to become to large market players, ideally not human large market players. You want it to be computerized large market players. Why? Because these will keep injecting regularly new unfilled orders that are not in the market yet. Okay, and therefore the edge time frames that those computers use are going to be Fibonacci numbers. Okay, we're going to be using the 2-minute time frame. We're going to be using the 3-minute time frame. We're going to be using the 8-minute time frame. We're going to be using the 21-minute time frame, the 55, the 144, the 377-minute time frame. So these type of time frames, which are Fibonacci numbers, which could be minutes, but also could be tick charts or volume charts, all those edge time frames will give us an edge by spotting those computerized large market players, joining their unfilled orders that are already in the market, and joining the unfilled orders that are likely going to be injected in the market but have not been added yet. Okay, we're going to be doing that, having identified first what is the climate, what is the market condition, thanks to the common time frame. Okay, so minimum 2 time frames, and as I said, optionally we could also use the reactive time frame, okay, which is going to be a very tiny time frame, giving us an extra confirmation that the unfilled orders we thought were available in the edge time frame are confirmed and seen in a reactive time frame. Okay, so now you got even more probability, but again, as I said before, the price to pay for that addition when it comes to evidence would be that you may miss the trade when you get to see the evidence, price already moved too much, and it's too late for you to enter, because now you will be chasing the markets, and we should never do that. Okay, so going back to the flow chart, now that I give you a repetition of what are those time frames, notice that the first thing that we're going to do is use the common time frame, okay, to check the climate. Okay, use the common time frame to check the climate. And when looking at the climate, 2 things may happen. The climate could be confirmed, or the climate could be unconfirmed. So what does that mean? Climate could be 2 things. Up market, okay, market going up, or down market, a market going down. Okay, and that was a terrible drawing I just did. So let me erase it. So the climate could be an up market or a down market. When looking at a market, you can look at it from different angles and confirm it's an up market, or you can look at it from different angles and get contradictory readings that tells you it's looking like the market is going up, but it's also looking like it's going down, or vice versa. It's looking like it's going down, but it's also looking like it's going up. You may get contradictory information. If you get contradictory information, that's when we say the climate is not confirmed. Therefore, taking the trade is optional. Some of you that may want to be more active, you may be okay trading unconfirmed climates. The probability of your trades working will be less. Okay, the probability of your trades working will be less, but it could still be okay. Okay, it could still be okay because you have other elements in the trade in your favor, such as AutoUFOs, etc., and therefore you may still end up with a profit. Okay, now in a perfect world, of course, it would be higher probability and better to only trade confirmed markets, because if the climate has been confirmed, then you have stronger odds in your favor, and therefore it would be an easier trade. Of course, some of you may only trade, let's say you only trade the euro, and today the market has an unconfirmed climate. Well, if you were to not to take the trade, well, then that means that today you don't trade, right? So you have 2 choices. either take the trade even if the market is unconfirmed, which is less probability, or go ahead and trade more markets. So if the euro is not good, you go trade crude oil. If crude oil is not good, you go trade the S&P. Okay, that would be better, and that would put you always trading confirmed markets, which I guess is common sense. Would increase your probability of profitability. You should do a better job only trading confirmed markets. Okay, that's I would say common sense. Okay, but again, some of you may have very limited time to trade, or maybe you have a personality where you really, you have a very good control of your mindset and you don't get affected by emotions and things like that, and therefore you are open to trade both markets. That would be okay. Some of you may be a little more sophisticated and you say, you know what, I'll trade confirmed markets, and when that's the case, I will use 100% of the position size I want to trade, and if the market is unconfirmed, I'll still take it, but instead of 100%, I'll go with 66.6%. I'll go with 2/3 of my normal size instead of full size. Okay, and if you were to do something like that, it makes sense too, even though now we are making it a little too complicated. Okay, so my recommendation would be you either decide to take both confirm and unconfirm, or you only decide to take confirm. That's why unconfirm is optional. Okay, but of course, you can certainly create a little bit of variations to the rules compared to what I am exposing you to. The less you change it, I would say, the simpler your methodology would be. But if you have some experience and you understand well the rationale behind the methodology, and you want to come up with your own flow chart by doing a couple of tweaks, and you make it a rule, and from there you always use it the same way, mechanically, professionally, with discipline, then it's fine. Is that making sense? I'm just adding information so you understand not only the flowchart, but also in case you are a little more advanced, for you to know how to do the tweaks if you choose to do the tweaks. Okay? Again, probably not a good idea to tweak it, but if you have a good reason, maybe it makes sense. Okay? So let's talk about the climate. Okay? So let's get into TradeStation here. Okay, and what's the climate? Okay, how do we define the climate? Well, we learned a long time ago that the step one, and thanks for that, Bojan. It seems that you like the word climate, so that makes me very happy. Very good. So step one, very good to see you, Mark. Very nice to see you, my friend. So step one in the methodology, as we learned, was to look at the prior close. Okay, the prior close, and look at where is the prior close. Okay, where is it? Okay, compare versus the EMA. Okay, we are using the 9 EMA, isn't it? It's a 9 EMA. So where is the prior close? In other words, is the prior close above the EMA, or is the prior close, let's say that was the prior close, is it below the EMA, which is my gray line? As you can see, it's a exponential moving average. Okay, and I'm using 9. Why am I using 9? Because it comes by default like that in most trading platforms. So I'm looking at common parameters, because again, those are likely going to be the ones that computers utilize to add unfilled orders that are not in the market yet. So you don't want to get too fancy. Many people have the tendency to customize indicators, adjust indicators, backtest indicators. Let me tell you, it's likely going to be a little bit of a waste of time. What you want to do is to attract unfilled orders that may not be in the market yet. And how do you do that? By using the most generic settings are going to be the ones that will more likely produce or add unfilled orders in the market that are not there yet. Okay? So what are we going to do? So step one of the methodology would be to look at where the prior close is compared to the average. Okay, and in this case, the prior close is above. So what is the second step? Well, you will look at the DMI. Okay, you will look at the plus DMI and the minus DMI. The plus DMI, it's above the minus DMI, and that's why in on my screen it shows. Sorry for that. It's just giving me a little bit of a double arrow here. It shows as blue. Okay, so blue means you got more movements to the upside, plus 25, and less pushes to the downside. Only 15 is the size of the push to the downside. 25 is the size of the push to the upside. So in other words, the impulses kicking in the market are to the upside, and the average price movement is going up because the prior close is above the average. So we are looking at two different types of market information. We are looking at where is the price compared to its average, but we are also looking at the sizes of the pushes to the upside and the sizes of the pushes to the downside. And by looking at the market from those two different angles, we get the same confirmed information. We get the same confirmed information. So this is what we can say, that the climate has been confirmed. Okay, and by the way, I have a very good news for you all, guys. Very, very soon, you're going to have available, instead of using DMI, you're going to have available, okay, and this is going to be available for everyone. It's going to be, this is going to be an analysis technique called AutoClimate, okay, which will not be charged. And when you activate that tool, it's going to give you all sort of information that will be extremely useful here in the bottom part, that will tell you a lot about what's going on with this market, and certain things that are very, very relevant, because again, I'm maybe it's not the right time for me to explain this. Let me see, just 1 second, guys. I want to status line here, so I wanted to font status line. I wanted to make this just a little smaller, so hopefully I can get all those figures in. Yes, here we go. So here it's giving me some other metrics, 0.51, 7.21, 5.10. So I need to explain what is this, because this is going to be extremely powerful. This is something new that we're going to do to make our trades better that we haven't done yet. Okay, and I'm going to have this new tool available for you right now, if that's okay. I am just kind of flashing it so you get to see it visually, so you get the visual. I'm going to disable it, and I will come back later to explain that much better. Okay, so I'm back to the regular basic DMI that we have been using up to this point. Okay, anyway, so as you know, guys, we are going through a process together, one step at a time, to keep evolving as traders, and therefore we are a technology company, and I keep adding tools for you guys to be able to make yourself less human, more mechanical, less affected by the emotions, where everything you do is rule-based and so on. Okay, so those tools are going to allow you to check the climate, confirm if the climate is confirmed or the climate is unconfirmed. Hey everyone, before I continue, could you please, everybody could confirm that you hear me well, the screen is updating on your side, everything is okay? Because I see a little comment there from Bojan. Yes, exactly, Bojan. More alien, isn't it? Less human, more alien. So that's why we use the UFOs, isn't it? Love it. Okay, got it. So it seems that there have been a little bit of an interruption, but everything is back to normal. Good, perfect. So let's continue. So again, you will check the climate. Okay, look at if the climate is confirmed or not. Okay, and once you check the climate, the next step will be to define the final target. Okay, so you check the climate and then you define the target. Okay, but now here's important: to define the target, okay, which is the final target. Okay, important word, final target. You need to be realistic. In other words, if the climate is confirmed, you are in a very powerful environment, okay, where the market is up powerfully, the market is down powerfully, then the targets, are likely going to be far. Okay, so then instead of using the common time frame, the same common time frame that you have used to begin the process to check the climate, okay, instead of using the same common time frame, you will go for the next. Okay, what does that mean? It means that if you were using the 15-minute time frame, then you would look at the 60. If you were using the 60-minute time frame, then you will look at the 4 hours. If you were looking at the 4 hours, then you would look at the daily. If you were looking at the daily, then you will look at the weekly. Okay, so you will just go ahead and use the next common time frame to set the target. Okay, and of course the target is going to be your AutoUFO. It's going to be your, if the climate is an up market, then your target will be a red UFO. If the climate is a down market, then your target will be a green UFO. Okay, and those UFOs will be found in the next common time frame as long as the climate is confirmed. If the market is not confirmed, then you will do the same thing, but instead of looking at the next common time frame, you would just use the same common time frame that you started the process with. So if you started with a 15, then the target would be found in the 15 if the climate is unconfirmed. If the climate is confirmed, then you started the process with the 15, okay, for instance. So then you would then go ahead and look at the target using the 60-minute time frame, which is the next common time frame based on the list I shared with you earlier. Good, perfect. Yeah, thank you guys for confirming that it's all good. Very good. So yeah, so again, the time frames, let me bring the time frames, okay? Let me bring the time frames. So I'll start with the longer term, okay? So here is a list with the longer term time frames, okay? And please, for now, ignore the table on the right, okay? Let's focus on the table on the left, and also please ignore the reactive time frames for now, okay? So let's focus on edge, okay? And also let's ignore range. So for now, let's simply focus on minutes, right? So what will be your plan? Well, your plan is that if you are planning on a swing trade, position trade, long-term investment, and you are doing that using the daily, the weekly, or the monthly common time frame, okay? Well, if you use the daily, then your edge time frame, okay, your edge time frame would be 55. If you were using the weekly time frame as common, then your edge time frame would be 144. If you were using the monthly time frame as common, then your edge time frame would be 377. In other words, if you look at the daily and you find that you have a confirmed climate, it's an up market, it's a down market, it's confirmed, then you will look for the target on the weekly. It's the next common time frame. If you were to plan the trade with the weekly and you had a confirmed climate in the weekly, then you will look for the target on the monthly. And if you were to plan the trade with the monthly, okay, there is nothing above monthly, so you would still use the monthly for the target because there is nothing above, so we cannot go above. Is that making sense? But that would be the plan. Okay, that would be the plan. And same happens if instead of using those time frames, you were to use, wait a sec, let me go ahead and look at this one. So if you were, again, please go ahead and ignore range, ignore reactive, and ignore the whole thing on the right for now. So if you were to use the 60-minute time frame as a common time frame and you had a confirmed climate, then you will look for the targets using the 240-minute, okay? And 8 would be your edge. If you were to plan a trade using the 4-hour time frame, please type on the chat box what the time frame would be used for target purposes if the climate was confirmed. So if you use the 4-hour time frame and the climate is confirmed, you will look for targets in, please type which time frame, okay? And the edge would be 21. The edge would be 21, that's correct. My question is not about the edge, my question is about which time frame will you use to set targets. If 4 hours, it's the time frame that you use to look at the climate, to set the target you would use, very good Frank, you would use the daily time frame, which is the next common time frame. Okay guys, so this is what next common time frame means. Very good. Well, 480 is not common, Bojan. So certainly you can create a variation of the plan for yourself, and using 480 would certainly not be something crazy, okay, and it would certainly make sense, okay. But again, we are looking for the common, okay. So the common would be daily, unless you choose to create that variation for yourself, okay. Good. So please go ahead on the chat box and confirm to me that up to this point everybody's following. Everybody good? Perfect. Yes, 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 yes. Wonderful, wonderful. Perfect. Okay, so let's continue. Okay, let's continue. And please don't be shy to type on the comments box. Okay, so let's continue. So now, what else do we have here? Okay, interesting. It's not allowing me to drag it. Why is that? Okay, so let me zoom out and let me zoom in again, and it should allow me to drag it. Here we go. So now you have identified the target. So what's next? Well, now you need to have a combination. You need to combine the common time frame and the edge time frame. This is needed to define the entry. Why is it needed to define the entry? Because to define the entry, you need to make sure that you find a valid UFO lining up with an average calculated on the common time frame, isn't it? So for example, in here, okay, in here, and you know what, let's use the other desktop here. Okay, so here we got, okay, perfect example. So we have, if I was to go back to the beginning of the methodology, right? So on the common time frame, which is 15, okay, I have the prior close is below the average and the DMI is red. So this is a confirmed climate. Okay, confirmed climate. So guys, by the way, question: if the common time frame is 15 and the climate is confirmed, as I just said, question: which time frame should I use to check my target? If the common time frame is 15, I will have to use which time frame? Go ahead, you guys tell me. Which time frame? Very good, perfect, 60. So I would take my 15-minute time frame, change it to 60, activate my AutoUFOs, okay? And notice how the UFO is down here at 7888.5. So this would become my final target. Okay, this would be my final target. Okay, and we may get there, we may not, but if we do get there, you are out of the trade and the trade is over. This is what final target means. Okay, and this was the very prior step. Okay, but now that you found your climate, which is a down market in the case of the S&P, and you got your final target, okay, which was 888.5. Now we're gonna look at a combination where we're gonna combine the common time frame and the edge time frame to define the entry. And defining the entry means that we need to find a UFO lining up with the average. So the average, it's 80.25, right? So we do have UFOs at 80.25. So we do have a valid entry. In other words, if the S&P, which is currently, this is the NASDAQ. If the NASDAQ, which is currently trading at, 80.15, this is the value of the NASDAQ, isn't it? If the NASDAQ was to come back up, and reach 80.25, okay, on the bottom chart, it will look something like that. It went back to the average. And what is time to do? Time to short. Why? Because we are shorting at a price where we got the on-field orders, and we also have the average, meaning that in one hand, you short at an average price. In other words, you are not selling low. Okay, you are not selling low. But on top of that, most interestingly, this is a price where most of those computerized large market players are going to start adding on-field orders because it's an average price used by computers. So what's going to happen? What's going to happen is that the on-field orders available in the market that you can see already are going to hit the market, pushing it down. And if it doesn't go down quickly and it comes back up, okay, and those on-field orders, let's say they were not to be enough, well, then this moving average that is likely to act as additional on-field orders entering the market is going to finally push it down, and hopefully we will reach our final target. So we got the market climate in our favor. We got an accurate and precise entry point thanks to the AutoUFOs app that identify the unfilled orders in the market for us. And on top of that, the average is making sure you're not going to use UFOs too low, but also is making sure that potentially new unfilled orders will be added to the market to produce a drop, out of that average. Okay, like it happens many times, like here. Okay, went to the average and from there failed. Okay, or the opposite is true. Went to the average and from the average it went up. Right? So all of these are nice profits to be made, because remember, this is the 15-minute time frame, where this is the 2-minute time frame, this is a share time frame, this is a tick time frame. So those tiny moves, those tiny moves that we look to be tiny on the 15-minute time frame, this is a multiple point move on the time frames above, which are the edge time frames. Okay, those 3 time frames above are edge, and the time frame below is the common one. Okay, so we are looking for those, let's say, tiny bounces, which happen to be not so tiny. Okay. Yes, Frank, very good point. The EMA would start moving up, okay, and this is also something to keep into consideration as the market goes up and reaches the average. Okay, well, the average is not likely going to be 25 anymore, maybe 26, 27. Okay, so not only you need to look at this price and that price, okay, you also need to look at the extreme price for the UFO, which is 28.75. So even if the average goes up, you're still likely going to be somewhere in the middle of the UFO, okay, when the trade takes place, okay? And this is exactly what we're looking for. We are looking for the average to be somehow surrounded by one or multiple UFOs. That's what we're shooting for, okay? We want the average to be surrounded by that, okay? That's exactly what we're looking for. So we need to kind of anticipate that in our mind, okay? So what do? So you're looking at the common and the edge time frames. That helps you to define the entry. In this case, with the Nasdaq, we do have a valid entry, isn't it? So the answer is yes. So if we have a valid entry and the answer is yes, then we're going to do what's below, okay? If the answer was to be no, so let's say we didn't have a UFO, so then you will wait for new UFOs to form, okay? But you don't wait forever. You wait until you have a close on the common time frame, because the moment you have a close on the common time frame, you need to restart from the top, okay? So you will be waiting for new UFOs to form, maximum 15 minutes, okay? If you happen to be using the time frame I just showed you, okay? Maybe use a different time frame, maybe use 60 minutes, so then you will need to wait maximum 1 hour. Maybe use the 4 hours, so then you will need to wait maximum 4 hours, okay? So this is not waiting for you until the infinite. This waiting word always it's reset by the beginning part of this flowchart, which is reset every time you have a new close on the common time frame. In other words, every time you have a new dot that appears, okay, on the common time frame, you restart the whole process, okay? So again, in this case, we do have a valid entry, so the answer is yes. So now, instead of focusing on the common and edge time frames together, now we forget about the common time frames, and now everything is all about the edge, okay? It's all about the edge time frame. Okay, and what do we do with the edge time frame? Well, now we're going to look for the stop loss. Okay, because we know the entry. The entry is the red UFO. So the question is, where is the stop going to be? Okay, so let me go back to the chart so I repeat how we do that. Okay, the entry is going to be the bottom part of the UFO. The stop we need to be above the UFO plus 1 tick. Okay, above the UFO plus 1 tick. So the top of the UFO is 28.75. Therefore, the stop loss, okay, the stop loss would be 80.29.00. That would be the stop loss, right? And two things may happen. 80.29.00 may fall into the white space between UFOs, okay, or may fall inside of another UFO, okay? And if that's the case, we need to be careful. We cannot have the stop inside of a UFO. Because when you go short, your stop loss is a buy order, right? And if you were to, for example, in this case, okay, take a look. The top of this UFO is 28.75. The next one, okay, begins at 29.25. So if my stop is 29.0, then I am exactly in the middle. I am on the white space. So that would be a valid location for the stop. But careful, 29, okay, 29 happens to fall somewhere here. That's 29. The beginning part of this UFO, it's 28.25. So 29 is here. This is 29. And the top is 35. 35.5. So actually my stop should go here, right? Because if I was to place my stop at 29, yes, true, in the middle chart, the stop would be in the white space. On the chart on the right, it would also be on the white space because 29 is right above 28.75. So it would be on the chart on the right and the middle, it would be on the white space. That's what you want. But on the chart of the left, it would be in the middle of the red. And why is it wrong to have your stops in the middle of the red? Where it's wrong because a stop loss when you short is a buy order. And what do we have in the red? On the red UFO, inside of it, we have sell on field orders. So if you have sell on field orders at 29, why would you ever buy? Given the fact that you got sell on field orders. The market is likely to fall, but instead of selling, you are buying, right? So you never want your stops to be inside of a UFO. That's the very simple rule to remember. You always want your stops to be on the white space, not on the red or not on the green. You know, if the trade was to be long, then it would be the same story, but it would be on the green. So you don't want the stops to be on the green or the red. You want the stops to be on the white. And this forces you to look at whatever time frames you use as edge, okay, which based on the prior screenshots I show you, okay, if you are doing Forex, for example, and you use the 60 and the 8, right? So, you know, you only have one edge time frame, which is the 8 minutes, okay? You may use range time frames. So if you use range time frames combined with minute time frames, then you need to look at the 8 minute and the 8 range, right? So you need to make sure that your stop will be either above or below the UFOs found on the 8 minutes and the 8 range. If you are using the 240 minutes, you need to make sure that your stop is going to be, sorry for that. If you're using the 240 minutes, you need to make sure that your stop will be above or below the UFOs found on the 21 minute and the 21 range if you use the range time frames. Remember, the range time frames, we said that long time ago, are optional. You don't need to use them. They could help you, right? If you are using instead of using shorter time frames, you use longer time frames. Same story. You look at the 55 minute and 55 range, or 144 and 144, or 377 and 377, and you will want your stops to be above or below on the white space, okay? Making sure there is no overlapping UFOs in those two different charts, okay? If you are doing this on futures, you got a little extra complexity, because with the futures, let me zoom in. So with the futures, let's say you are doing S&P. So if you do S&P, ES is the S&P futures, right? So if you're using the 15-minute time frame as common, then you will use the 2 minutes as edge. But also for the futures, which is a centralized product, we also use share and tick bars. So you will use the 2584 share bars, and you would use the 1597 tick charts. So that gives you 3 edge time frame: minute edge time frame, shares edge time frame, ticks 8 time frames. That is why on the futures workspace we have 3 time frames on the top. Those are my 3 edge time frames, and then I got the common time frame on the bottom. I believe that you guys, are familiar with this, but just in case, I'm repeating it. Okay, so again, the concept that we are exploring here is when defining stop, very simple rule to remember. You want your stops to be on the white space. You never want your stops to be in, you never want your stops to be located within some other UFO in some other edge time frame that you didn't notice. You always need to look right to left to make sure that your stop is indeed in the white space, no matter the time frame. Okay, no matter the edge time frame. Okay, so that's how you would define the stop. Okay, so everybody, please, earlier you confirmed to me that everybody understood how to define the climate and the use of the common time frame. I would like to confirm now with all of you that everybody understands how to use the edge time frame to define the entry and the stop. Please give me that confirmation so I am clear that you are clear, so I can keep going. Very good. Okay, that's good. Perfect. Thank you, guys. Thank you very much for the updates. Again, it's critical to me to know that you are with me. Okay, so as I always say, this is teamwork. So thanks for that. So now that all of this has been confirmed and that you guys are with me on this process, so what we need to do now is to go ahead and go to the next step, which is we got the entry, we got the stop. Those two things bring us to the next box, which is quantify the risk and define the size. Okay, so quantify the risk basically means to calculate the distance. Keyword is distance. What's the distance between the entry and the stop? Okay, the vertical distance. How many cents, how many points, how many pips? Okay, so you quantify the risk, and based on the risk, you define the size of the trade. You will say, okay, the risk of the trade is 2 points. Okay, let me write it down just as an example, and then I'll go ahead and I'll explain that properly. So let's say the risk of the trade is 2 points. Okay, let's say that was the case. 2 points means that your entry price was, 80.32 and the stop was 80.34. So that would be 2 points of risk. And let's say every point, okay, the point value, okay, based on the website, based on the CME in this case, we're looking at the Nasdaq, is $20 per point. So what is your risk? Okay, so your risk is $40. That's your risk. Okay, why? Because you have 2 points of risk where every point is $20. So if that was the case, you have $40 of risk key per contract. This is per contract. Okay, so now the question is, how much do you want to risk per trade? Okay, and I will explain that again much better later. But right now I just want to explain it super quick. So let's say you told me, you know what, I am willing to risk $100 per trade. Okay, so if $100 per trade is your decision, and every time you take this trade per contract, you're gonna risk 40. So what is your size? Well, it seems pretty obvious that the size in this case, okay, would be 2 contracts. Why? Because if you take the trade with 2 contracts and you are wrong and you get stopped out, you're gonna lose 2 times 40, which is 80, which is less than 100. What if I use 3 contracts? Where if I use 3 contracts, you will lose 3 times 40, which is 120, which is more than 100. So in other words, I cannot use 3. My size would need to be 2, and I would execute this trade with 2 contracts. I would go long 2 contracts or short 2 contracts, depending on the trade. So I want to take this box to the next level later on, if that's okay with you guys. But for now, I will say that that will be enough. For you to follow the process. Okay. So you quantify the risk, you define the size. Let's say you concluded, I need 2 contracts, I need 5 contracts, whatever. So what would you now do? You would define the safety target. Okay, you would define where is the safety target. And what is the safety target? Well, remember, the safety target is a mathematically calculated target. The safety target, it's not identified like the final target. The final target uses UFOs. Okay? The safety target, okay, uses the calculator. That's how you calculate the safety target. Okay? So, example, let's say you are going long. Let's say you are going long. Okay, so in this example, we're going to talk about going long. And let's say your entry, from up to down. Okay, let's say your final target was 2,500, right? And you need to calculate where's the safety target. Okay, and you know your long entry is 2490. And you know that your stop loss below the entry is 2488. Okay, so what's the case? Well, the case is that you have a risk of, that was unfortunate, I just hit the wrong button. Okay, so you had a risk of, okay, your risk is 2 points based on what I said, right? Because we had an entry at 2490 and the stop loss was 2488. So that's 2 points of risk. So what do? You're gonna set a safety target. So your safety target will be 2492. How did I come up with 92? Well, if the risk is 2, which is the distance from 90 to 88, I'll take that number 2, which is the risk of the trade, and I will add 2 to my entry if it's long. I will subtract 2 to my entry if it's short, and this will give me an exit at 92. We call that the safety target. Why? Because what we will do at that safety target is to close 50% of the position size. So earlier I said, let's pretend my size that I have calculated here, right? My size is the step before. My size was 2 contracts. So if my size is 2 contracts, 50% of 2 contracts is 1 contract. So what will I do? When I get to 92, I will close 1 contract. And what is this going to do to my trade? It's basically removing 100% of the risk. Why? Because now, if instead of after reaching 92, the market was to continue to go up and reach my final target, if instead of that, the market was to turn around, drop, and hit 88, how much would I lose? 2 points. But I will lose 2 points with 1 contract. While I lose 2 points with 1 contract, I have made 2 points with 1 contract. When I got to 92 and I sold a contract, I made 2 points with 1 contract. So you make 2 points with 1 contract and then you lose 2 points with 1 contract. So what is the net result? Break even. You didn't make money, you didn't lose money. So safety targets are very efficient to remove the risk of the trade very, very quickly. And this is very good. This is a pure 1-to-1 sub-hash, very good. And this is very good because now not only you remove the risk of the trade, which probably gives you peace of mind, helps you to ease the process on how to manage your own emotions, but on top of that, what's the additional benefit? Well, the additional benefit is that now you can execute another trade in parallel, and even though you are executing a second trade, this is not increasing the risk that you are executing, because really the risk of the first trade is gone. So now you don't care what's going to happen to the first trade anymore. And again, you have the market climate in your favor. You have the EMA in your favor. You have the UFOs in your favor. Everything is in your favor. The fact that you reach target 1, safety target, means that the market is actually moving in your way. So you actually have evidence that what you thought would happen is actually happening. So all of this is increasing your odds. And while you increase your odds and you remove the risk, okay, now you can leave this trade alone, let's see what happens to the trade. Probably you'll hit the target. If you don't, it's okay because you cannot lose anymore. And in parallel, you can take other trades. So if this trade is not successful, hopefully the next trade makes money for you. And by the way, when I say hopefully, there is no hope because you're going to trade the other trade the same way, which is with an entry and stop, with a safety target, with a final target, by looking at the climate, by looking at the UFOs, by looking at the edge timeframes. The whole process will be the same for the next trade. Yeah, Bojan, it's a warm, fuzzy feeling. It's nice, and it's nice not only because to keep your confidence up, you have to price yourself. So you take a little bit of money out of the table, and that's a way to price yourself. It gives you the warm, fuzzy feeling, and this builds your confidence up for you to take the next trade by following the process religiously, mechanically, with discipline. Is that making sense? And again, now you can take multiple trades in parallel without increasing risk. So it does have a benefit. Of course, everything in life got pros and cons. Okay, it also reduces your size, and if you were to reach the final target, the net profit will be less. But wait a minute. The net profits will be less for that one trade. But what if you executed two trades in parallel, right? And they both end up profiting? Well, actually your profit is more because instead of one trade, you executed two while you remove the risk very quickly. Okay, so this is normally helping for consistency. And I could have made this safety target optional, but notice that I didn't. Okay, because again, something that we always need to keep in mind when we trade is the impact of those emotions. We are human, half alien when using the UFOs, isn't it? But we still have that human component that will imply this emotional impact at times. And we need to make sure that we got this under control. Okay, and one way to get this under control is to add peace of mind by knowing that you are now in a trade you cannot lose anymore. This is nice, very nice. Even if you are very experienced and you have traded for a long time and you have a very, very strong mindset, you're still human. Okay, so it's going to help you, and therefore I didn't make it as an option. Okay, which of course you can make it an option for yourself, but in the flow chart is not optional. Okay. Bojan had a few of those trades this past week, which I was posting in the Telegram room. Yes, I saw them, Bojan. And good job, my friend, by the way. And very kind of you to post it. And by the way, very nice as well of the other members of the Telegram group. Replying back to you, following you, kind of accompanying you in the process. So very, very nice teamwork. Yeah, and thanks for that, Subhash. Very nice comment, the last one you just had. So anyway, so now that you know what is your thing about it, we know everything, right? So we have defined the climate. Out of defining the climate, we have ended up defining the final target. After defining the final target, we found the entry and the stop. Thanks to that, we define the safety target. Okay, by the way, I forgot to say we define the size too, right? So you have the final target, you have the size, you have the safety target, you have the entry, and you have the stop loss. So what else do you need? Nothing. It's time to execute the trade. That's where we are at now in the process. Okay, now there is one optional box. Okay, one optional box right here, okay, which is, as I said at the beginning of the session, you could optionally use the reactive time frame, okay, to take the trade. Okay, this would increase your accuracy, but it will also increase missed trades, and this may have an impact in your emotions. Some of you get impatient. Okay, some of you may get impatient if you miss two trades in a row. You're gonna be like, oh, now I'm not using reactive anymore, and now you got this mindset impact that could be tricky. Okay, so I make it an option because to some of you it's going to help, especially if you are very conservative, but at the same time it may not be the best choice. That really depends on your personality. So the reactive timeframes, I have them here. Okay, I have them here. 233 share bar, 144 tick bar for the Nasdaq. So basically, if this market was to come to the red UFO and now you expect it to fall, and it does begin falling and shows you red UFOs like that, that's your evidence. You thought you would find on-field orders around 8025, and guess what? You are finding them, and the evidence of it is that those UFOs shows up on the screen. Okay, so if that's the case, okay, now you can say, okay, I got the confirmation thanks to that reactive time frame, so I'm gonna execute the trade with that additional peace of mind, okay, that additional evidence. Again, I personally am not a fan of it because, you know, I don't like to miss trades, but to you, it may work very well to have the extra confirmation if that's your personality, okay? From there, two things may happen. And by the way, I'm about to give you a break. Two things may happen. The trade you just executed gets filled or doesn't. If it doesn't get filled, then you go back to the beginning of the process and you keep observing the beginning part of the process. And whenever you have a new close, you restart until, you know, the whole process here, you know, works. And next time you execute the trade, then you get a yes for being filled. Okay, so if you don't get filled, you just wait. Okay, and you wait until the beginning of the process. If you do get filled, well, now you are in a trade, so now it's time to do trade management. And we have, as you can see, 6 possibilities for your trade management. Okay, but I will talk about that after the break. Okay, so I'm going to give you a 5-minute break, and as we come back from the 5-minute break, we will look into the trade management, and therefore at that time I will be able to say that now you understand the flow chart, and hopefully that's going to make your life way easier. Okay, if there's anything in the flow chart, by the way, which is not well understood, you know, please use the 5-minute break to type it on the chat box, so when we are back, I'll be able to take a look at this and help you with it. Okay, so 5-minute break. See you in 5. Okay, everyone, we're restarting in a little less than a minute. Please go ahead and confirm with a quick message that you hear my voice. That would be appreciated as a sound check, so that way I know we can start. Great, thanks for that, everyone. So we got 10 seconds and we restart. Yeah, Frank, send us an email, please, to reach@tradewithufos.com, and we will send you the link for the Telegram group so you can join it, okay? Thanks a lot. So anyway, so let's talk about trade management, okay? So now you are in the trade, okay, and now what? Well, two things may happen. Okay, you may end up profiting, you may end up losing. The idea is to manage the trade in ways where the outcome of the trade is as under control as possible. Okay, that's, oh, sorry guys, it's kind of funny sometimes when I click in places. Here we go. So, so the idea, as I was saying, the idea is to manage the trade, obviously to try to maximize the probability of leaving the trade with at least some sort of a profit. Of course, you don't want to cap the profit too short, because then this would produce a negative impact on your trading methodology if most of your trades were to profit very little. Because if you were to take two or three losses in a row, now maybe you would need 10 trades just to make the money back, which is obviously absolutely inefficient. So you want to profit as much as possible within reasonable parameters. That's why we use the methodology we just described. But also there are certain other actions that could be done manually as well to try to maximize the probability of a profit in case you were to identify a market condition changing, in case you were to identify that the UFO you expected to work so well is not working so well, things like that, right? So going from left to right, the first thing that we're gonna do is to set a stop loss. And I didn't right now, I'm not adding anything new. This is already defined before. We have it here on the very left, isn't it? So one of the steps in the methodology we just covered was to define a stop loss. So when would that stop loss be hit? Well, that stop loss will be hit and triggered the moment the market was to move against you all the way, like non-stop, until it reaches the stop, right? And this may happen at times. And when that's the case, you will take the loss, and that's it. You already calculated, you already quantify the risk, define the size, all those things when you did that step here, right? So therefore, you should be okay with it. It should not be a big deal, and it's part of trading, okay? But in any case, in order to try to minimize the amount of times receiving those stop losses, we talked about using time stops. And by the way, in the sessions that we cover, I always talk about time stops as optional, where in this case in the diagram you can see I didn't write the word optional. I made it as a rule to be used all the time. And again, this is because one of my key priorities when leading these sessions, apart from helping you to take whatever you do in trading to the next level, it's also to keep you safe. And this is especially important among the traders that you are less experienced, that you have been trading for less time, or maybe for more time, but without finding consistent results. So then priority number one is that you don't lose, and from there you can grow. But if you start exposing yourself to trades, and what you thought would happen is not happening, but you keep hoping, please happen, then next thing you know, you will end up too often with stop losses instead of ending up with the profits, right? And so that's the purpose for the time stop. And even though, as I said before with a safety target, and I said, I didn't make it optional. If you choose to make it optional, you could make it optional. The same happens to the time stop. If you choose to make it optional, you could certainly make it optional. but I'm not gonna propose that you make it optional. I'm gonna propose that you make it part of your rules, just to be extra safe. So what is a time stop? A time stop is a stop that applies to the edge time frame, okay? The one time frame that is based on time, because it's a time stop. So if your edge time frame, like we saw in futures earlier, let me bring it up again. If you have the 2-minute time frame, right? For edge, you have the 2-minute time frame, and then you have the 2584 shares and 1597 ticks. Well, you got a problem with the shares and the ticks. What's the problem? Is that shares and ticks are not related to time. They are related to shares and ticks. And a time stop is related to time, which means that the time stop would be applied to the 2-minute. Okay, that's the only time frame you will look at when looking at the time stop. And you probably remember the rules that we use all the time in the sessions, which is anywhere between 3 to 5 candles on the 2-minute time frame. In this case, that would be your edge time frame based on time. So if you have 3 to 5 candles on that time frame and you didn't reach the safety target after 3 to 5 candles, then the instruction would be to close the trade immediately for a profit if you are in profit, or if you are already dropping into the losing territory, okay, then you will want to place your exit orders to the break-even point, okay? So hopefully you can exit the trade for break-even, and hopefully you will not lose. If you lose, it's okay. It's part of the outcome, okay? But you would want to minimize the probability, and therefore, instead of having a safety target higher and having a final target even higher, then you would just place your exit at the same price where you entered, which is represented by this horizontal line, and you would just get out at break even if possible. Okay, the last Tuesday, if I'm not mistaken, we had that situation, isn't it? You may remember it, where we had a trade working against us. The time stop rule triggered, so it was time to exit. Unfortunately, at that time, the trade was losing a little bit of money, so we moved our exit to break even, but unfortunately, the market never came back to break even. The market kept falling, and a few minutes later, we hit our stop loss. So you know what? It's part of trading. It's okay. Okay, but the purpose of the time stop is, let me repeat it one more time, if you haven't reached your safety target in 3 to 5 candles from the edge time frame based on time, you just need to conclude that the trade you thought would work is not working, and therefore you want to get out, ideally for a profit. If not, get out for a break-even trade. That's what this means. Okay? Subhash, for long time frame, if multiple UFOs, then we may not require stop loss. Well, you always require stop loss unless you use options. So what happens with long-term time frames is that we often use options. And when you use options, the most you can lose is what you pay for the option. Therefore, it's like your stop loss is built in. So if a market is worth $20,000, but instead of investing $20,000 to trade the market, you buy an option which is worth $300. So you know, even though the market is worth $20,000, the most you can lose is $300 because you paid $300 to buy an option. Therefore, in that case, it's okay not to use stops because the option price is your stop. Okay, so the stop is built in, and you may think about it like I'm not using stops, even though the reality is that the stop is built in the price of the option. Okay, so that's why for longer time frames, Subhash, we often not use stops, but it's because we're using options. If you were to trade stocks without using options, then you would need to use stop losses like it is explained in this flowchart. Sorry guys, I forgot to unmute my microphone. Too far too fast, okay, is what 2F means. So too far too fast is nice to see. When you have a market move very fast in your direction, makes you very happy, right? You see the matrix, you see that golden color kick in, and you're like, oh my God, that's beautiful. But what's the reality? The reality is that, like in nature, if you throw a ball very hard, very fast against the wall, well, the faster you throw it against the ball, the faster it will bounce back against you. So if a market is moving very fast in your favor, it's nice to see, but it increases the probability of the market turn around and move against you. But the bad news is that if that happens, it's likely to move against you just as fast. Okay? So the way to deal with this would be to trail your stop. Okay? Trail your stop very quickly to follow price. So if the market is going to turn around without reaching your target, then at least you will get out of this trade for some profit instead of get out of this trade for a loss. That's the idea. This is what the too far too fast exit means. Okay? And the way you do it, is the following. So you look at the distance between entry and safety target, okay, and you take half of it, okay, and if the market has moved by that amount, you start moving your stop by halves. Okay, you start trailing the stop by halves. Okay, and this probably better explain if instead of let me bring the sharpening notes document because it's written there, and I believe it's worth it now to read it. So here's the sharpening notes document. So if I move down until finding the methodology, almost there, here we go. So how much is the profit at your safety target? If it's 100, you divide it by 2, you take the half, that's what I meant, and this is 50. So this is now your reference. Okay, so you're looking at the matrix, right? And the question is, how many times have you produced the reference profit without any ally UFO? So if the market is moving your way, okay, if the market is moving your way, right, and instead of doing something like that, move, create a UFO, move, create a UFO, move, come back, react to the UFO, move, create a UFO, move. If instead of having this type of move where UFOs are being created on the way, you just have something like that, that's too far too fast, right? So for every time you reach the reference profit, which is half of the profit you would make at the safety target, okay, you would then move the stop at the same amount as long as no UFOs are being formed. Okay, so if your stop was here, okay, and this is the amount of move that triggers, so you take that and you move it to half. The moment the market moves by the same amount again, you move it another half, and you just keep moving your stop trailing price. So if the market was to now, here you have it again, right? So now your stop is here. So if the market instead of keep going and reach your target, let's say your target is up here, the market was to drop and hits your stop, okay, right here. So guess what? It's not ideal, but at least you made that side of a profit. You didn't leave the trade with nothing when the market moved too far too fast, okay? And you saw me apply this, and you saw me apply this in some of the trades, okay? Bojan, Jose, I think we should also make up a rule like this. You are not allowed to make up rules mid-trade. Yes, very good, love it, because that means that your methodology is incomplete, okay? Every situation that happens in trading should be reflected in your methodology. So if you ever find yourself creating rules halfway into a trade, it means that your methodology is incomplete. So you should have a rule that says don't create rules. Just leave your trade alone, and once the trade is concluded, as a homework, go define a rule. So next time this happens, you have a rule. Okay? So Bojan, if unsure of a situation happens for which you think you don't have a rule for, close the trade and ask a question about it. Very good. Very good. Yes, Frank, for the Word document to be available, just email and we'll send it to you. Okay, so reach@tradewithufos.com. So what else? Now I have to say the Word document is a mess, okay, because I just keep typing stuff in there. It's not as beautiful as the flowchart, if you wish. Okay, so it's you know, it's just a document. I mean, you know me. You know, I like to combine neat documents with kind of like improvised documents, okay, which they're never improvised, but somehow I think it's quite healthy when I share you know, the skill of trading with you, that sometimes as I speak I type. I think that's quite healthy to help you internalize it better. So that creates those documents, but those documents are made as we go, so they're not too neat, okay? But still, I'm very happy to share with you if you need it. So just email us, okay? Then we have the UFO trailing exit. So what is the UFO trailing exit? Well, the UFO trailing exit is when new evidence comes into place, okay? New UFOs forming in the edge time frame, then you immediately replace the stop right beyond that new UFO, okay? So if you have what I said before, so the market is moving your way, what you thought will happen is happening, but not only that, a new UFO forms and it keeps going. So what should you do? You had a stop somewhere below. Your stop should now be replaced right here. Why? Because if this market was to come to the UFO, the normal thing to happen is to bounce. Okay? And you do it again. Okay, and you will do it again. If a new UFO forms, okay, then you want to place your stop here. Why? Because if the market comes here, it should bounce. And if it doesn't, you want to be stopped out, because probably the climate has changed and this market is about to fall very much. So you will want to be out here, and therefore you would have made a profit from the beginning to that new location for the stop below the last UFO that formed that showed you additional evidence. So if the additional evidence fails, you want to get out. Okay, so this would be what here it showed as UFO trailing exit. Okay, and finally, final target. Final target means that it kept going and going and going, and it did reach the final target. So then you congratulate yourself and you go for the next trade. Okay, and any of those 6 outcomes will happen from time to time. From time to time, you'll be stopped out. From time to time, your time stop will trigger. From time to time, you'll hit the safety target. From time to time, the market will move too far too fast, you'll have to trail. From time to time, you will have new evidence, you will have to trail. From time to time, you will hit the final target. Of course, this is the ideal situation, but it will not happen every time, it will happen from time to time. Okay? So while you are waiting for any of these to happen, okay, the trade may close or may not. If the trade is not closed yet, you are just working on this cycle. This is like an infinite loop, ready to execute any of it anytime. Now, if the trade closes, and closing means stop or final target. Okay? So if any of these happens, then you log the trade. Okay? Log the trade and plan the next one. Thank you for your comment, Subhash. I'm very happy to read that you feel the document is amazing. Okay, so hopefully it will be amazing. It is amazing, and it will help you guys. Okay, that's the intention. Okay, so anyway, so here is the flow chart, my friends. Okay, this is the flow chart, and to be honest, you know, you take 20 trades following this flow chart, and after 20 trades, this is embedded in how you think for the rest of your life. Okay, so it's quite simple, and you know, in no time you don't even need to use it anymore. But in the process of putting this together, in the process of making sure you don't make mistakes, in the process of internalizing this, hopefully this document will help you. Okay, so guys, there are two more things I want to discuss with you before we end the session. Before I do, though, I would like to get some confirmation from you guys that up to this point you follow the whole process, because if you follow the whole process, you know the method. Okay, and I need to know that. If you don't, I need to know that. If you do, I need to know that. So please, teamwork, go ahead and type something short on the chat box, so I know you are with me, or I know you are not. And if you're not and you don't feel comfortable saying it, so please send us an email, reach@tradewithufos.com, and let us know, because we are here to support you guys. So if you need support and you don't say it, then it's difficult for us to help. Okay, so you know, I could understand maybe you don't feel comfortable to type it on the chat box, but certainly you can send an email to us. Okay, and we'll keep it obviously private, but we will become aware that you need support. Okay, cool. Thank you guys, thank you very much. Perfect. Okay, so two things I want to discuss with you. I want to go back to climate, and I want to go back to size. Okay, I want to explain a little more about those two, and let's begin with size. So 1 second. I need to find, I have a few slides that I would like to use. Okay, 1 second guys. Okay, I just need to find where the slides are, and I'm gonna get them up very quickly. 1 sec, almost there. Let me see. Okay, good. I found the slides. So just 1 second, I just need to move them to the right place on the screen, so you get to see it. I just need 1 more minute, guys. Sorry for that. Okay, now, yeah, I was using the wrong set of PowerPoint slides, but now I am positive I am using the right one. Okay, so let me see. Perfect. Okay, so here is what I want to share with you. Let's go over this together. So calculating the size, okay, and this, it's probably known by many of you, but just in case, I think it's important stuff. Okay, so to calculate the specific size to be used per trade, we need 5 pieces of information. Number 1, what is your account balance? Number 2, what is the desired trade risk as a percentage of your account balance? Okay, so in other words, let's say you have an account which is 10,000, and let's say you tell me, okay, you know, the amount of money I'm feeling comfortable risking per trade is $100. Okay, well, as a percentage, that's 1%. Okay, so 1% of 10,000 is $100. Okay, so you need to know what is your account balance. That's easy. You also need to define what is your desired trade risk. Once you have decided those two values, then, and this applies to all the trades that you take, then you will look at the specific parameters of the trade you are executing. Number one, the distance between the entry and the stop. I'm going to call it ES, E for entry, S for stop. Account balance, I didn't say it. I'm going to call it AB, A for account, B for balance. And desired trade risk, I'm going to call it R for risk percentage because it's a percent. Then you also need to know the minimum price fluctuation of the market you trade. We're going to call it MF. The minimum price fluctuation, for example, for stocks is 1 cent, 0.01. For Forex is 1 pip, which is 0.0001 for decimal places in most currency pairs. For the S&P futures, for example, the minimum price fluctuation is called the tick, right? And it's 0.25, etc., etc. Then you need to know the multiplier value for the minimum price fluctuation. We're going to call that MV. So what is the minimum multiplier value? What is the multiplier value for the minimum price fluctuation for stocks? Well, if the minimum price fluctuation for stocks is 0.01, 1 cent, the value for that for stocks is 1 cent. Okay, for stock is very easy. The minimum price fluctuation, MF, is the same as MV. So it's very simple. But it's not the case for Forex or futures. For example, the minimum price fluctuation for the S&P futures is 0.25. And the multiplier value for 0.25, okay, is $12.5. That's for the S&P. But it's not for the NASDAQ. For the NASDAQ, it's different. For the NASDAQ, the minimum price fluctuation is 0.25. Okay, like the S&P, same thing. But the multiplier value for that minimum price fluctuation for the NASDAQ, it's not 12.5, it's 5. Okay, you may remember, you probably know that 1 point in the NASDAQ is $20. 1 point is 4 times 0.25. 4 times 5 is 20. So the minimum, the multiplier value for the minimum price fluctuation is 5. So basically we need five values to calculate the risk and therefore the size of a trade, where 2 of them are constant all the time. So the 2 on the top of our formula are going to be the same all the time. If you got $10,000, you got $10,000. This is going to be constant, let's say for your trading day. R, if you're going to risk 1% of your account, 1% of 10,000 is 100. That's going to be constant for your trading day, even maybe for your trading week, even maybe for your trading month. So even though I just said we need 5 values, the reality is that we only need 3. Okay, and by the way, if you trade the S&P, the MF and the MV for the S&P is going to be constant all the time. So really, the only thing you need to know to calculate the size is the distance between your entry and your stop, which is what we saw on the flow chart. In any case, to make sure that this is well understood, I want to give you an example with a stock first. So let's say you have an account of 10,000 with a desired trade risk of 1%, which is $100, and you plan a trade where your entry is 101.25 or your stop is 135, which is a distance of 90 cents. ES equals 90 cents. Entry stop 90 cents. For stocks, the minimum fluctuation is 0.1 and the multiplier for 0.1 is 0.1. So what do? You plug this into the formula. You got 10,000, 1%, 90 cents is the ES, right? ES, 90 cents. And then the MV and the MF is 0.10, 0.10. Okay? So what's the net result for that? 111.111. So what do? You round down to 111 shares. Piece of cake. Right? So for stocks, it's normally quite simple. But what if instead of stocks, you're using Forex? So let's look at example number 1. Use Forex. Your account is 10,000. Let's say you decided you want to risk 1% per trade. That's $100 per trade you want to risk. Let's say you are trading you're trading the euro. Okay, you found a good entry at 112.12. The stop is 112.03. So you got 9 pips of risk. 0.0009 is 9 pips. The minimum price fluctuation for the euro is 0.0001. That's 1 pip. And the multiplier value, the MV for the euro, if you trade micro lots, which depends on your broker, it's $10 per pip per micro lot. Okay, you get this from a pip calculator from the internet. And if you have been trading Forex for a while, you know this by heart. So the MV is 0.10. So you apply this to the formula and you got 10,000, 1%. The ES is 9 pips, which is 0.0009. The MV is 0.10. The MF is 0.01. MV, MF. So that is going to tell you 111.111. You round it down to 111 micro lots, because up here I got micro lots. But what if I use a broker that instead of trading micro lots, that broker is giving me access to trade mini lots? So let's say you have a mini lot account with broker B. If you have a mini lot account with broker B, the whole thing is going to be the same. Your account is 10,000, your risk is 100 because it's 1%. The ES, the distance between entry and stop, is 0.009. The MF, the minimum fluctuation, is 0.001, which is one pip, but the MV is not the same. Why? Because you are not trading micros, you are trading mini lots given by your broker, and based on a pip calculator on the internet, or if you have been trading Forex for a while, you know this by heart, you got a minimum, you got a multiplier value MV of $1 per pip per micro lot. So what do? You apply this 1 divided 0.0001, same as before, and now you don't get 111, you get 11.111. Of course, as it says, you always run down, so you end up with 11 mini lots for the trade. Instead of 111 micro lots, you got 11 mini lots if that's your broker. What if your broker is giving you access to trade full lots? Okay, and to make it a little more fun, what if you're using the Canadian dollar Japanese yen, which if you trade Forex, you know the minimum fluctuation for the yen currencies is not 0.0001, it's only 2 decimals, is 0.001. Okay, so what if that's the case? So again, and to make it even more fun, let's say your account is 20,000 instead of 10,000. Let's say your percentage of risk you won is 0.75% instead of 1%. That is $150. So you will plug 20,000, you will plug 0.75% into the formula. Let's say your entry is 82.45 on the CAD, your stop is 82.31 on the Canadian dollar Japanese yen, so that gives you an ES, which is the distance between entry to stop. Your ES will be 0.14 with a minimum fluctuation of 0.01, and let's say your broker gives you access to trade full lots. Full lots are known as standard lots, and by using a pip calculator on the internet, you found out that the multiplier value is $9.20 per pip for standard lots. So you plug your ES 0.14, you plug your NV 9.20, you plug your MF 0.01, this is coming from here, and it will give you a result of 1.165. You always round down, and therefore this trade would be executed with one standard lot. That's how you calculate this thing. Okay? And again, it's a piece of cake because the reality is that many of those values are the same all the time, isn't it? What if it's futures? So let's say you're doing a trade with the S&P 500 futures. Let's say your account is 20,000. Let's say your risk is 1%. So that's $200 per trade. Okay? You look at the ES which is the distance between the entry and the stop, which funnily enough is also the symbol for the E-mini S&P 500. But in this case, it means entry to stop. And the entry is 30.10.75. The stop is 30.09.25. This is 1.5 points of risk. So what is the minimum fluctuation MF for the S&P? Is 0.25. And what is the multiplier value for the minimum price fluctuation? What is the MV? It's $12.5 per tick per contract. Your MV is 12.5. Where did I get that from? The cmegroove.com website. Okay, if you trade futures for a while, you know these by heart. So what do? Take 20,000 times 1%. Take the ES, which is the distance between entry to stop. That's 1.5. That's your ES. Take your MV. We just said MV is 12.5. So you add 12.5. Take the MF. We just said the MF is 0.25. So you type 0.25. And this tells you 2.66. 2.666. So what do? Always rounding down. So this trade will be executed with 2 contracts. This is how you make sure the risk you take per trade is constant. You need to trade with constant risk, because sometimes you profit, sometimes you lose. So when you profit, you want to profit something that is predetermined, and when you lose, you want to lose something that is predetermined. You don't want to lose random figures, where sometimes you lose randomly great and sometimes you lose randomly small, just because sometimes you felt like using 5 contracts and sometimes you felt like using 1 contract. You want to have an exposure to risk that is constant. That way you can have a consistent outcome in your trading activity. And how do you find out how do you adjust your risk to be constant? You adjust the risk to be constant by changing the size, because you cannot change the ES. Okay, you cannot change the ES, the distance between entry and stop. You cannot change that. Why? Because the distance between entry and stop is dictated by where are the UFOs, and the UFOs are dictated by where the on-field orders are, and the on-field orders are placed in the market by the larger market players and their computerized systems. We cannot change that. We don't have the power to move the on-field orders. That would be great, but we don't. So we cannot change the ES. If the distance between entry and stop is 1.5 points, I cannot change that. I cannot change the MF. The minimum price fluctuation is set, in this case, by the CME, the Chicago Mercantile Exchange. I cannot change the MV. The MV is 12.5. This is set by the CME. So what is the only thing I can change? The trade size. So what do I need to do every time before I trade? Calculate the right size. And how do I do it? I follow the formula I just described for you a couple of slides before. That's the formula. Okay? This is the formula. And this is what we do when applying this box. Okay? Cool. So please, confirmation that you followed me so I can address the last subject for the day and we'll call it the day. Subhaj, just require suggestion as I prefer swing trading to internalize the process. Would you recommend to trade in short-term time frames? Absolutely. Short-term time frames will allow you to practice more often. It also requires more of your time in front of the computer, but it will also allow you to practice more often. So I would certainly open the door to that. Okay, therefore you can internalize the process quicker, and then you can apply it to the larger time frames if you plan to be a swing trader. Okay, so good one, Subhash. The MF for stock is 0.01 if you trade in the US markets. Okay, this is defined by the US exchanges as well. Okay, other markets, okay, may be different. Okay, maybe you trade markets which are traded in a very weak currency, and maybe you have minimum fluctuations of 10 cents, per tick. So again, you need to know the markets that you trade. But again, I would guess that 95% of you are going to be focusing on the US markets, and that's 0.01. Even other markets such as the Singapore exchange, etc., is 0.01. But again, you need to know the markets that you trade, okay? This is set by the exchanges. I put down 0.10 instead of 0.1. Mark, would you mind to share if that was in the Forex trade or the stock trade? Because I believe I didn't. Maybe I'm wrong. Let me quickly. Oh, you're right. You're right. Yes, this should be 001. You are correct. Sorry for that. Good catch. Thanks for that. Thank you very much, Mark. That's such a silly mistake, but certainly a mistake. Okay, so this should be 001. Okay, so 001, 001, and therefore 001, 001. The result will be the same because if you divide the same value by itself, so it's going to be 1. So the result will be the same, but certainly I made a mistake here. So good catch. Thanks for that, Mark. Good. So there is one last thing left for me to discuss with you. And again, I want to keep it very short. So just give me 1 second here as well. So what I want to discuss with you guys is about the climate, okay? And I did flash something very quick earlier. I want to flash it again so you understand it a little better, even though I will prepare this properly in a way where we can have proper sessions to talk about this, okay? So for now, when we look at climate, what I have been asking you to do, which is absolutely fine, so please don't change it, okay, is to look at the close and the moving average, and if the close above or below the moving average, and then confirm the climate with the DMI below. This is what I have been asking you to do. Good news, we have completed a new app for TradeStation called Auto Climate that looks like this, okay? And I want to show you what this does. Because we'll make this very, very soon available on the TradeStation App Store, and all of you will be able to subscribe to it. And by the way, it's going to be a free app, so everybody will be able to subscribe, okay? But this app is doing something quite cool, okay? So first of all, I'm going to load plenty of data. So for example, instead of 2 years of data, let's say, for example, I'm going to load 10 years of data. Okay, so if I load 10 years of data, which is, I guess that we all agree it's a lot of data in a daily time frame, okay, in this case with Apple. So what the app is going to do is that it's going to apply the climate methodology, okay, and it's taking a little bit of time because it's downloading, so it'll show in just a sec. There is a lot of statistical analysis that the app is doing too, as you will understand in a second. And by the way, 10 years is way too much. I just want to give you an example of something a little kind of like really big, so you understand the concept really well, okay? So what the app is doing is that the app is applying the climate methodology for those 10 years of data. And when this is ready, surprise, why is taking so long? Yeah, I can see TradeStation is downloading data. Okay, now good. So when all this is loaded and the app calculates and plots in the bottom. So again, what the app is doing is it's applying the climate methodology. Okay, and there are multiple things that the app is giving you. So first, the app is giving you those dots, where as you can see, they can be blue, or as you can see, they can also be red. So you have the dots, blue or red, and you are guessing it. Blue means it's an up market, where red means it's a down market. Okay, up market and down market. So that's the first thing. Second, you can see that some of the dots are thick, where some of the dots are thin. So thin means it's not confirmed, where thick means it's confirmed. So for example, at this time, we had an up market that was not confirmed. Where here we have an up market which is confirmed, okay, because the dot is thick, where here the dot is thin. Okay, so visually speaking, you have the color and the thickness. So without having to look at the average and the close and the DMI, automatically you know what type of market you have. Next, you have this vertical bar on top of it, which this is telling you how far is price from the average based on an ATR calculation. In other words, if the price is very close to the average, okay, the vertical bar is very short. If the price is very far from the average, then the vertical line is longer. Okay, as you can see, it's a longer vertical line. In other words, we're going to be able to use this climate app as well in our scanners and be alerted of the markets that not only have a defined and confirmed climate, but also the markets that are close to a potential entry, instead of markets that, yeah, they are in a very strong market, but the market is so far from an average that it's going to take multiple days for price to arrive to the average for us to take the trade. Is that making sense? So this is going to save you plenty of time as well when planning your trades. But on top of that, and this is something that is new when it comes to looking at the climate, the app is running stats of what is the nature of this market, in this case, Apple. And the nature of this market is when this market goes up, statistically speaking, okay, and those are standard deviation calculations, statistically speaking, up markets tend to last 7.28 bars, and down markets tend to last 5.02 bars. So why is that important? Because, for example, if you look at where we are now, okay, so let me move this to the right, to the left. So the place where we are now is a defined up market. So we got a thick blue dot. This is a defined up market. That's good. But what's even better to know is that you got 1, 2, 3, and 4 candles. You already got 4 candles in this particular current condition. And you know that statistically, when this market is in an up condition, it tends to remain in that climate for 7.28 candles. In other words, taking the trade now is sensible. Let's say you have already been, like for example at this time, 1, 2, 3, 4, 5, 6, 7, 8 candles, right? So 8 candles brings the market here. In other words, the market already moved all of these. Okay, the market already moved a lot. Could it continue moving? Yes. Is it likely to happen? Based on statistics, is more likely to not to happen than to happen. Sometimes it will happen, sometimes it will not. Most of the times when the market is up, it will tend to last around 7 point something bars. So because currently is 4 bars, I would love it that the market comes in here, gets me filled, because at least I could enjoy 3 more bars going up to meet that number. Okay, guys? So not only we're going to be looking at the climate, but we will also very soon we'll add a few rules. Okay, once this app is available in the App Store, which will take probably a couple of weeks or so, because there is a validation to be done. I'm just sharing this with you guys because I'm excited, but there is a validation and everything to be done for this to be available, for you to be able to download it into TradeStation and all of this. Okay, so it'll take a little bit of time, but I wanted to show it to you because we're gonna soon add to our climate analysis also the duration of the climate. You know, when it's sunny, it tends to stay sunny for X amount of days. When it's rainy, it tends to stay rainy for X amount of time. So if it's been sunny for too many days in a row and you keep expecting more sun to come, it may be too hopeful. But if it's been sunny for not too long, it may be very sensible to expect to be sunny for a few more days, because that's what tends to happen when it's sunny, or that's what tends to happen when it's rainy. You guys with me with the concept? Okay, I just wanted to show this to you to understand some of the things that we're going to be doing soon as well in this process of keep improving what you guys do with the use of technology and stuff that we keep adding, guys, for you guys. Subhash, I have a question on TradeStation 10, not able to refresh charts for 377 minutes. Could you please advise if any change in setting required at the end of the session? That's a weird thing, Subhash. I would recommend you to call TradeStation and try to understand what's happening, because this is not normal. You should be able to refresh no matter the time frame. Very interesting approach, Jose. I love it. Thanks, Bojan, for that. Cool. Okay, everyone. For now, I will disable the auto climate. I will go back to the DMI. Okay, which again is more than enough and does a very good job. Okay, but again, adding stats also adds a little bit of an extra edge. Okay, very good. Thank you very much, Frank. Thank you very much, Bill. It's exactly the time to conclude the session today. So, hey, let's call it the day. Thanks for joining me, guys. I know you guys do a tremendous effort to make time over the weekends to join the sessions. I know some of you watch it recorded as well. So, again, it still takes time to watch it recorded. So, you know, kudos to you guys watching this live and also recorded. Okay, don't forget to give us a thumbs up if you're happy with the sessions. Also, especially if you're watching this recorded, make sure you subscribe to the channel, and certainly make sure that you click on the notifications bell so we are in sync more efficiently. Everyone, take care. Enjoy the rest of the weekend. Really enjoying those sessions on my side. Hopefully it's the same on yours. See you next week for trading. And again, shoot an email to us, rich@tradewithufos.com. If you need that we send any document to you, you could have taken screenshots in the session, but if you prefer that we send you the documents, shoot an email to us, give us just a little bit of time, and we'll reply that email, with the corresponding documents. Okay, Subhash, yes, it will be available on TradingView, probably a little after TradeStation. Okay, but it will be available as well. Anyway, everybody, you guys take care. See you soon. See you during the weekdays. Bye-bye. Enjoy the weekend.